So to help us understand what this rate hike means, both there and here, senior business correspondent Peter Armstrong joins us. So Peter, what is the message U.S. Federal Reserve is trying to send?
Well, mostly that it thinks it can make all of this work, that it can hike interest rates, and that will cool demand and calm inflation, all without slowing things so much that it causes a recession. But that path, it's a really narrow one. And as you know, some of this is being driven by domestic demand and high housing prices, and high interest rates will soften that. But much of it's being driven by global forces too. Supply chain issues, food prices, and of course, the price of oil. So raising rates right now, it's easy. The hard part comes down the road as rates continue to rise, as consumers scale back and the economy slows. But if gas prices remain high and inflation stays up, what do central banks do then?
So I know we're talking about a Federal Reserve decision, but these are Canadian issues to a degree as well.
They are indeed. And look, one big difference between what's happening in the United States and here is the Canadian economy has been performing better than its G7 peers. I mean, the U.S. economy contracted to beginning the year. Canadian GDP grew by like 3.1%, at least in part, of course, because high oil prices benefit the Canadian economy. And all of that, it just gives policymakers a little bit more cushion. But look, we're going to get Canadian inflation numbers next week, and economists expect it to come in red hot above 7%. So brace yourself. All those trends we're seeing in the U.S., they're coming here.
And you will be back here as well.
I will indeed.
All right, senior business correspondent Peter Armstrong, thanks.
You bet.